Good afternoon. I hope everyone is doing well this afternoon. We're just going to start in approximately 1 o'clock. We're going to give it just a couple of minutes for our guests to log in and come through the doors, the virtual doors, that is, of this Zoom presentation. I hope everyone's doing well this afternoon. It's always good to know where everyone's logging in from. So if I could ask for people to just in the chat box, let us know where you're zooming in from virtually, whether that's in Australia or even overseas. It's always good to know, and we'll do a few shout outs while we wait. Lovely, thank you, Christina. She's in Brisbane. That's good to know. Just while we're waiting, my name's Fossey Qureshi. I'm the General Manager for Informa Connect Academy. I'm sure you may be well aware of who we are and what we do, but we're a corporate training provider based here in Sydney, but we are a global organisation. We deliver training across the world, and we specialise in a number of different areas here in Australia, obviously focusing on some of our major industries like oil and gas, mining and energy, obviously being a prime area that's continuing to grow in terms of both learning opportunities and things that are constantly changing in the energy sector. If you're just joining us, we're about to start very, very shortly. We're just letting some people come into the Zoom call. Like I said, if I can get some people to just let us know where you're dialing in from. We've got Mark from Sydney. Alex is in Sydney as well. Thanks for typing that in, Alex. Much appreciated. And we'll give it maybe another 15, 20 seconds, and then we'll kickstart the webinar. But Matthew in Melbourne. Hi, Matthew. Hope you're well. James in, I'm going to butcher this, Rogallo, Queensland. Mary in sunny Sydney. It is sunny indeed. It's nice weather here in Sydney today. All right, so I think we've got a really decent number of people attending today. I think we'll kick things off. So it's my great pleasure again to welcome everyone to this webinar. My name's Fossey Qureshi. I'm the General Manager for Informa Connect Academy. It is my great pleasure to welcome the effervescent Maria Petkovic from Energy Synapse. And Maria is a regular at this point in terms of webinars that she does with us. But for those that don't know, Maria is a leading expert in the wholesale electricity market. She is the founder and the managing director of Energy Synapse. Before I hand it over to Maria, there's just a couple of housekeeping things that I just wanted to talk to you about. The first, and this is obviously a very common question, is a recording going to be available at the end of the presentation? And the answer to that question is yes. So there will be a recording. And there will be a Q&A session as well. So what I would suggest is if you can hold your fire in terms of your questions right until the end. There is a Q&A tab at the bottom that you can see on your Zoom. If I can ask you to put your questions into that particular tab, we will then go through those questions at the end. But I'll now hand it over to Maria. Thank you so much, Maria. It's great to see you, and over to you.
Thanks, Bazi. It's a pleasure to be back on this webinar again with everyone. So listen, what we're going to cover today, all about Australia's energy transition. So we'll start by going through some of the key issues and points that we saw throughout 2024, and then we'll go into the trends to watch for 2025. So really this session is for anyone who's interested in utility scale renewables and storage. Now, I've seen in the participant list, there's a lot of familiar names on the call today. So some of you will already know myself and what we do at Energy Synapse, but for those who might be coming across us for the first time, I'll just give you a little bit of background on us. So Energy Synapse is an analytics and advisory firm. Our mission is to empower the clean energy transition through data. We do a couple of different things. We make a data platform called the Energy Synapse platform, which gives you everything you could possibly want to know about the NEM and the opportunities for renewables and storage. We also do bespoke market and revenue modelling for utility scale renewables and batteries. And of course, we do a suite of corporate training services with our partners at Informa Connect Academy. So we have the electricity industry fundamentals course and the commercial opportunities for battery storage in the NEM course as well. And I'll be talking about those two courses as we go through this session today, because all the material that we'll be going through in today's webinar is very relevant to what we cover in those courses. So I'll let Fazi just tell us a little bit about the special offer that we've got on those courses today.
Thanks very much, Maria. So just as an appreciation of everyone's time for being in this webinar, we are offering a special rate of 10% off the pricing for these two courses, the first being the Electricity Industry Fundamentals course, and the second and the new course, which is the Commercial Opportunities for Battery Storage in the NEM. As you can see on your screen, there are dates right across Australia for both courses, as well as the opportunity to do this course virtually. So like I said, there is a 10% discount. If you have any questions or queries in particular regarding either of those courses and just need some further information or any questions, please don't hesitate to contact my colleague Dean. His contact details are at the bottom of that screen, or you can alternatively email training@informa.com.au. So really looking forward to this, Maria. I'm going to hand it back to you, and yeah, off we go. Thanks, Maria.
Wonderful. So the first thing we're going to look at today is a bit of a snapshot of where we are up to in the energy transition in the national electricity market. So we ended 2024 with variable renewables, so that's wind and solar, generating about 32% of all the electricity in the NEM. And then if you were to include hydro on top of that, that's 39% renewables across the national electricity market. Now you can see there in this chart, we've got a bit of a breakdown state by state, so those percentages can vary quite significantly. We've got, of course, South Australia, who is not just an Australian leader, but a global leader when it comes to the uptake of wind and solar. So they generated about 74% of electricity from wind and solar. And then Tasmania, of course, they lead the NEM in terms of overall renewable generation, thanks to their large portfolio of hydro power plants. And then we've got the coal-heavy states of New South Wales, Queensland and Victoria, where really when we talk about the energy transition, the bulk of it is happening in those three states that do still have a very large dependency on coal. So that's where we were in terms of the energy mix and the electricity being generated in the market. But I also wanted to just provide a bit of a snapshot on what's happening with projects under development. So 2024 was actually a very strong year for investments in the clean energy sector. There were about 4.3 gigawatts of renewable generation capacity and 4 gigawatts of storage capacity that reached financial close throughout the year. So that's going to be a lot of new projects that will be coming online over the next couple of years. So on that previous slide, we saw that on an annual basis, variable renewables were about 32% of electricity generation. And that might not seem like a big number, but the thing is, when we break this down to an instantaneous basis, we're actually reaching much higher levels. So what we have on this particular chart is for every month of the year, we've found, what's the 1 30-minute block in that particular month where wind and solar contributed their highest share to the overall energy mix in the NEM. And you can see that's been growing very strongly over the last 7 or so years. And we're actually reaching on a NEM-wide basis over 72% in months like October and November. So they tend to be months where there is a fair bit of solar generation in the grid in particular, but the weather's quite mild. It's not too cold, it's not too hot, so demand is relatively tempered. So then that wind and solar is really producing a big portion of overall electricity. And then in South Australia, on an instantaneous basis, they're getting pretty close to 100% on a regular basis. So for them, it's not just those special months that are the shoulder periods of the year, but really around the year, they're reaching very close to 100%, which is, again, very much world leading. So the market operator in the NEM AEMO, they are already facing and solving the challenges that are associated with a highly renewable grid, because we've already got plenty of instances where we do have a very high portion being satisfied by renewables. One of the other trends we've seen in recent years as well, and 2024 was no exception, was the rise of negative pricing in the NEM. So back in 2017 and earlier, negative prices were a relative anomaly in the grid. And you can see that that's really grown quite sharply in some states, reaching over 25% of the time actually having negative prices. And that's creating quite a big price risk for solar farms in particular, because most of these negative prices are happening in the middle of the day. And as we've got more and more solar coming into the grid, those daytime prices are becoming lower and lower. So what that means is that for anyone who is developing utility scale solar projects, it's actually becoming quite difficult to finance those if they are a standalone project. So one of the other trends we'll talk about, of course, is the rise of hybrids. And this is, one of the reasons why hybrids are emerging as very popular, is to try to manage this negative price risk. And as I said, particularly for solar farms. On the battery scene, 2024 was really the year of battery storage. Our battery capacity doubled in 2024. So the NEM now has over 30 large-scale batteries that are registered to participate in the market. So what this chart is tracking is those registrations in the NEM. So that doesn't necessarily align with a project being at full commercial operation, but it means that they have registered in the NEM, their SCADA system's live, and they're very much on their way to being at full generation there. So we're really in a rapid growth phase for battery storage, and it is one of the key enablers in the energy transition. If our grid is going to be more dominated by variable renewables, then we need a lot more storage to be able to stabilize that system and to reduce our reliance on coal. So the biggest battery that we've got that's currently registered in the NEM, it registered around September of last year, I believe, and that's the Waratah Super Battery. So that's about 850 megawatts and 1,680 megawatt hours, one of the biggest in the world at the moment. And we've got that in New South Wales. So that one isn't fully operational yet, but it is registered in the market, and the SCADA system is live. So with those 30-odd large-scale batteries that are currently registered to participate in the NEM, the storage duration of those on average is about 1.6 hours. But you can see on this box plot, the medium is actually much closer to 2 hours there. So most of the batteries that we have in the NEM, they do have at least 1.6 hours of storage, and that allows them to capture opportunities in both the energy market and FCAS markets as well. There's one notable exception, which is Dalrymple. So that one only has about 16 minutes of storage. So that's very much a power battery. It's focused on network reliability and contingency FCAS, but really most other systems, they've got at least that 1.5 hours, if not 2 hours of storage. But interestingly, we don't yet have anything in the NEM that is operational that has more than 2 hours of storage. But that is a trend that we think will change. So we have seen in the last 12 months really a growing appetite for 4+ hour batteries. So under AEMO's ISP step change scenario, which is what we're looking at on this particular chart on the right here, coal is expected to exit the market by the mid to late 2030s. So I mean, that's only a bit more over 10 years away. So as that coal exits the market, those 2 hour batteries that we have at the moment aren't really going to cut it. We're going to need longer storage duration to provide that stability in the grid. So those 4+ hour systems start to become really important as more and more coal exits the market. We've also seen the Capacity Investment Scheme, which is the federal government's main lever for incentivising renewables and storage as part of the energy transition. So that capacity investment scheme is now also starting to preference 4-hour batteries. So we saw that with tender number 3, where that was a specific requirement of being in that tender. So there's a really strong fundamental case for having 4 hours of storage. And then there's also this policy incentive to have 4 hours of storage as well. And the developer market certainly has responded to both of those signals that they're receiving. But where we still have a challenge with 4-hour batteries is in the financing and the bankability. So banks have now started to become comfortable with the business case for 2-hour batteries, but 4-hour batteries are still seen as having bankability issues. So the thing with 4+ hour batteries is that the business case starts to become very sensitive to those coal closures. So if say governments step in and extend the life of coal, that's a really big risk to the revenue of those longer duration systems. And there's a lot of uncertainty around that. So banks still see a fair bit of risk with 4-hour systems, even though the fundamental value is there for those systems. So really for anyone developing a 4-hour battery, contracts become really essential, and whether that's the SIS or just entering or on top of the SIS, even entering into other types of arrangements with participants, those contracts are really essential to try to manage the revenue risks that are being seen by the banks. So the other key trend that we will cover is hybrids, as I alluded to earlier. So with all of those negative prices that we're seeing in the grid, solar and battery hybrids have become very popular over the last 12 months, but we are actually also seeing wind and battery as well, and in some instances, all 3. So before we go into more depth about hybrids, let's talk about exactly what is a hybrid. So we'll start with the standalone case first. So if you have a standalone battery, what that means is that you have a connection point, and then you've got one asset behind that connection point. So it could be a battery, or you could have a solar farm or a wind farm, but the idea is it's one asset behind one connection point that's standalone. Now, before we had true hybrids, the more common case was what you see on the right, which is a co-located asset. So that's where you might have, say, a solar farm and a battery on adjacent property. They're next to each other, but they actually have 2 separate connection points to the grid. So that's co-located. It's not a true hybrid. So when we say hybrid, what we're meaning there is that you've got more than one asset behind the same connection point. And what typically happens in a hybrid is that the total size of your assets is actually bigger than the capacity of the connection point itself. So for example, you might have a 200 megawatt connection, and then behind that, you might have a solar farm and a battery, which might have a total capacity of 300 megawatts. So your total asset capacity very often exceeds the maximum capacity at the connection point. So why are people so interested in these hybrids? Well, the first issue is around improving the dispatch weighted average price of your asset. So both wind and solar do suffer from this, but solar more so. So both wind and solar, they are zero marginal cost assets. And basically when we have a lot of wind and solar all generating in the grid at the same time, they really push down the wholesale price, right? And then when we don't have as much wind and solar and generators like gas and hydro get to control the market, they push up the price to much higher levels. So what's happening is that wind and solar farms, and especially solar farms, are really missing out on those higher prices that we're seeing in the market, and they're getting the lowest price that's available. And you can see an example here of just the average intraday price in Victoria. And you can see, especially in the middle of the day, that those prices absolutely tank. So if you're a solar farm, a standalone solar farm, you're not going to be earning a whole lot of revenue from the market. But if you were to put a battery at your site, then that gives you the ability to charge up that system when the energy price is very low or even negative, and then discharge for those very high peaks that your renewable asset would probably be missing out on. So then that allows you to get from that site much more value than you would with a standalone asset. But that, of course, isn't the only benefit of hybrids. There's a lot more to consider here. So one of the other key ones is all about improving the utilization of your connection. So say if I had a 100 megawatt connection and I was to put a solar farm behind that connection, well, I'm not going to actually be exporting at 100 megawatts at every single point in day. In fact, it's going to be pretty rare that I'm hitting 100 megawatts. And actually, same thing for a wind farm as well. So what you're looking at on the chart on the right here is the average intraday capacity factor for, just as an example, all the solar farms in New South Wales, so that's the yellow, and then all the wind farms in New South Wales as well, being the green. So you can see there that there is a lot of spare capacity really all throughout the day. So you're paying for, say, a 100 megawatt connection, but you're not actually utilizing that connection all the time. So what that means is that there's a lot of spare capacity for you to be able to put an additional asset like a battery to share that same connection. And again, the idea in a hybrid is that you have the sum of your generation and your storage in terms of power is actually higher than the connection export limit, because you're not necessarily going to be dispatching them both at the same time. So by adding this extra asset behind the same connection point, what that means is that you have an opportunity to reduce the connection costs for your project. Because if you were to have two separate connections, so one asset has its own connection and the wind or solar farm also has its own connection as well, you're going to be paying for two sets of connections, potentially two sets of substations. That cost can really add up. But in a hybrid, you're able to, by sharing that same connection infrastructure, reduce that cost. And that is actually one of the main benefits that developers are chasing when they're thinking about doing a hybrid project. The other benefit to consider is monetization of curtailed energy. So again, this is going to depend on exactly where you are in the grid. Often a bigger issue for solar farms. There's some solar farms in New South Wales that are losing about half of their potential production due to grid constraints. So that is energy that you can't do anything with. It's basically lost. So if you were to put a battery onto that site, it would give you the opportunity to utilize that energy rather than it going to waste. You could charge up the battery and then discharge that at much higher prices at a later point in the grid. So with monetization of curtailed energy as well, important to understand that energy that would otherwise be curtailed actually provides a free source of charging for your battery. So if your energy isn't constrained, there's an opportunity cost to using that energy because you could have sold it into the energy market. But if you're actually being prevented from selling that energy into the market, then that becomes essentially a free source of charging for the battery. And as long as that price isn't negative beyond the value of LGCs, it would make sense for you to store that energy into the battery instead of letting it go to waste. So a lot of these benefits we've talked about so far, you know, they talk about how the battery benefits a solar farm or a wind farm, but there are actually benefits to the battery of having generation co-located with it as well. And one of those is all about managing risks associated with network tariffs. So at the moment, network providers basically go into an individual one-on-one negotiation with you as the developer, and they have the power to implement a tariff for you to use the grid to charge your battery. Now, most batteries that have been built in the NEM at the moment, they have been able to negotiate zero charging tariffs, but that is a power that the network providers have. So if you have your own on-site generation, it gives you an opportunity to manage that risk going forward because it will reduce your reliance on charging from the grid. And the last thing to be aware of as well with hybrids is that there was a really big rule change that went through in June of 2024. And this is something that we cover in our training courses. And it's all about integrating energy storage systems into the NEM. And that has allowed a lot more flexibility in how hybrid assets are able to register and operate in the market as well. And that's both on the AC coupled side and the DC coupled side as well. And the final trend that we'll go through here is what we are seeing with the contracting markets as well. So there's been contract markets are shifting very, very quickly. And I'll just talk about two trends that we've seen emerging in the last year. So the first one is around virtual tolls. So this has become quite popular for standalone storage projects. So several years ago, we saw the emergence of physical tolls, and physical tolls themselves weren't necessarily a new mechanism. They've actually got a long history of being used for all sorts of power assets like gas peakers and the like. But basically what happens in a physical toll is that the off-taker of this toll will pay a fixed fee to the asset owner, and then the off-taker takes complete operational control of the asset, and then they, charge and discharge the battery or the storage asset however they like. So that's how a physical toll works, and that was the first types of tolling arrangements that we saw in the NEM for batteries. But what we've seen emerging now is what's called a virtual toll. So in that case, the off-taker isn't taking operational control of the asset. So it's now the asset owner that will operate the asset. But what the off-taker will do is they will pay a fixed fee for the privilege of being able to provide virtual charge-discharge nominations as a financial product that is separate from the physical operation of the battery. So as I said, the asset owner, they operate the battery, however they think is most optimum in the energy market, but they've got this contractual obligation, like a paper contract that they'll need to settle with their counterparty for those virtual charge-discharge nominations. And the way those variable payments work is that the off-taker will receive a payment based on the virtual volume that was nominated and then the actual spot price at that time. So typically they'll nominate on a daily basis, how much charging and discharging they want in certain time windows, and then that gets settled on the actual price. So by being able to separate charge-discharge nominations from the physical operation of the asset, what a virtual toll has essentially done is that it opens up your pool of potential off-takers. So in a physical toll, because the off-taker is going to take complete operational control of the asset, that off-taker really needs to be a very experienced spot market participant. So for physical tolls, your most logical counterparty to be your off-taker would be a gentailer, right? Someone who knows how to operate in the spot market. But with a virtual toll, your counterparty could be anyone. So it doesn't really need to be a gentailer anymore. It could be a hedge fund or some other financial institution who don't necessarily have the expertise to operate the asset, but they might have some of their own intelligence that tells them that, there's a certain opportunity that they want to pursue in the energy market. So certainly virtual tolls, as I said, that's really, really grown in popularity over the last 12 months. And then for hybrid assets, we're seeing some interesting agreements popping up there as well. One of the common ones we're seeing for solar battery hybrids and wind battery hybrids as well is what's called a time-based green swap. And some people call this a firm green block as well. So what happens there is that the asset owner will sell a fixed volume So a certain amount of megawatts as a financial product. So again, paper product that's separate to the physical operation of the asset. And that will be at a specified time window, because this is a time-based swap, not a 24/7 swap. So that time window might be, say, 5 to 9 p.m. And that might be a popular one for retailers who are trying to manage the risk of high pricing in the afternoon. Or it could be a larger window like 7 a.m. to 9 p.m. And that might be, that's quite a common one for solar and battery hybrids as well. So then the way that this settlement works is that it's settled as a contract for difference, or CFD. So that means that if the spot price is higher than the strike price that was agreed in the contract, the owner will pay the off-taker the difference. So basically the owner is protecting the off-taker from high prices. And then the reverse situation happens if spot prices are below the strike price, then the off-taker tops up the owner for the difference. So the off-taker protects the asset owner in the event that energy prices are quite low, and then the owner is providing the protection to the off-taker on the high side. So if energy prices are quite high, so both parties are then able to manage their risks through this type of contractual structure. But we're seeing this type of time-based green swap starting to be quite popular, as opposed to a traditional run-of-plant PPA that would have been very common for just a standalone solar farm or a standalone wind farm that was built several years ago. So in our training courses, we do go through a lot of other different types of contracts, both exchange traded products and then over-the-counter deals as well. But this is just two small examples of ones that we've seen taking off over the last 12 or so months. So I do want to take the opportunity today just to give you a little bit more information about these two training courses that we run, because we do get a lot of questions around which one is right for me. Should I do the fundamentals course or should I do the battery course? So I've just got a bit of a side-by-side comparison that I'll run you through very quickly. So the fundamentals course is all about giving you an end-to-end understanding of how the NEM works. So we do everything from wholesale markets, ancillary services, retail market, networks, and policy. And then the battery course is much more specialized. So we talk about the NEM in the very specific context of battery storage. In the fundamentals course, we'll go through all the different fuel mix options and the pros and cons of different types of power stations. So whether that be coal, gas, combined cycle, open cycle, hydro, solar, wind, battery. And in the battery course, we don't cover the other fuel types, but we really zero in on batteries and the different types of chemistries that exist, and their pros and cons and when you might want to use one or the other. We do cover contracts in both of these courses as well, but in the fundamentals course, you're really learning the fundamentals of exchange products, over-the-counters, and basic PPAs. So when I was talking on that previous screen, if words like CFD didn't mean much to you, it's probably best to do the fundamentals course. But then if you already know a little bit about this stuff, in the battery course, we talk about some structures that are a bit more advanced and specifically tailored to battery storage. And of course, in the battery one as well, we really go through the differences and opportunities for standalone versus hybrid battery projects as well. So to sum it up, the fundamentals course is best suited for those who want a holistic understanding of how the NEM works in Australia's energy transition. And then the battery course is better suited for those who want a deeper understanding of battery storage specifically and who already have a bit of an idea and experience in how the market works. So I'll let Bazi just quickly sum up the offer that we have today.
Lovely. Thanks so much, Maria, both for covering those trends, but also offering that comparison on the two courses. Just before I get into it, I do want to let people know that they can ask some questions. So if you have a question that you would like to ask Maria, please do so now, and we'll get to that just in a little over a minute or so. But whilst we're doing that, as Maria has indicated, we do have these two courses running across Australia, both the electricity industry fundamentals course as well as the commercial opportunities for battery storage in the NEM. Like I said at the top of the call, there is a special discount for those that are attending this webinar as an appreciation for your time. It's a 10% discount off the rate for these courses. Please reach out to my colleague Dean on the contact details provided at the bottom of the screen, or alternatively, you can email us at training@informa.com.au. So I think with that, Maria, let's jump into some Q&A, shall we?
Yeah.
I've got a question here. So the first question for you, and I'll read it out for you. It's what is your view on margins of standalone so battery energy storage systems post mid 2030s? Once there are more storage available, less volatility between change and discharge, wouldn't that impact in NBP or additional risks of standalone BESS projects?
Yes, so I mean, definitely your revenue stream for batteries is going to be very dependent on the fuel mix in the NEM. So if there was, say, a situation where we had a lot of new storage coming online, but coal not exiting the market, then that will have quite a severe impact on your business case. But I mean, if the coal actually does come out, I mean, you've seen from some of those earlier charts from AEMO, I mean, we need about 60 gigawatts of storage to replace that. We're only at about, you know, a small fraction of that, 5 or so. So there's a long way to go before we're actually saturated, assuming that that coal actually does come out.
I see. Okay. Another question is, what's the risk of a change of federal government to renewables?
Yes, so our industry is one that has been plagued with policy risk really over the last 15 years. If you've been around for that long, you'll know it's been quite chaotic from a policy perspective. So, you know, that's always a risk in every election year. The coalition is going to the election promising nuclear power. Most people in the industry don't really think that that is going to happen. It's more of a distraction play. It's really about trying to maintain the status quo for as long as possible. But the thing is, most of the coal in the country is actually owned by private companies. And what they're seeing is that these assets, you know, they're going bust pretty quickly. Like, it's just not economic for them to keep running them over the next 20 years. So private companies have a pretty strong incentive to actually transition away from these assets. And I'm not sure that federal policy is really going to be able to stop that. I think that's very much in motion. And then renewables and storage are the cheapest way to replace that new coal. So that's again been confirmed by the CSIRO, you know, earlier this year. So really, in terms of the fundamentals of the market, it's all siding at the moment with renewables and storage. So that's going to be a very difficult train to stop. In my opinion, if there was to be a change in government, I think there would be a pretty immediate temporary halt to investment while companies figure out, okay, what does this mean for us? But over the long term, I don't think that's a trend that can be stopped.
Very interesting. Next one is there an avenue for frequency stabilization through batteries? And would this be financially viable for a battery storage provider?
Yes, so in terms of frequency stabilization, so the NEM has 10 different markets for frequency control ancillary services, or FCAS, and batteries have actually been providing that service since the first battery was built in 2017, and that FCAS, or that frequency control, has been one of the main components of the revenue stack for batteries. So they're certainly able to do that. That's quite an easy thing for a battery to do. We are seeing a lot of innovation on more complex grid services, like virtual inertia and system strength, that some of the more advanced grid forming inverters are able to do. So those more advanced services, that's starting to be demonstrated now, but frequency control itself, very, very easy for a battery to do. And they've, as I said, they've been doing that since they were first built.
All right. Okay, so this one's, I'm going to try and go through this. It's a bit of a longer question, but hopefully I can convey it accurately. So this question is hybrid, it's in brackets, AC coupled single connection, in
Yeah.
bracket, being the failover of the year. It is a new implementation on the NEM, and AMO is still going through its learning curve for grid connection. Do you see this as a material roadblock in your various engagements?
I wouldn't say that it's a material roadblock. I think that rule change that became active in June of last year, so that's integrating energy storage systems into the NEM, that really clarified, from a registration and market participation perspective, it really clarified a lot of issues around how these hybrids would operate. Now, the actual grid connection process is a somewhat separate process. And any time you're using, say, new inverters or what else, I mean, that always can create a bit of a delay, but I don't see that as being a showstopper. Again, there's a lot of value in having the hybrid assets, and I don't think that particular train can be stopped either. I think, and what we've seen, just so you know as well, really I would say over the last 2 years, we haven't seen a single standalone solar project, say in Queensland, come by our desk over the last 2 years. Everything in Queensland, solar plus battery, because that risk of standalone solar and low daytime pricing is just too high. They can't get the project financed if it's standalone solar. So in places like Queensland, it's really a matter of you just can't get it built if it's standalone anymore.
I see. There's a few, if you're okay, Mary, there's still two or
Yeah,
three more. So
absolutely. Happy
some
to
really,
go through them.
good questions coming through. Next one is, what's your view on the future role of commercial and industrial BESS? And will C&I BESS be part of the agenda of the BESS course?
Yeah, so if you have a look at AEMO's integrated system plan, so that's the AEMO's basically blueprint for the energy transition over the next 20 years. They do have a fair bit of what they call customer energy resources. So that includes behind the meter storage, and that isn't just home storage, that's also storage that's behind C&I customers as well. So we do see that market having an important role to play. I mean, it's not just a case of do we do only utility scale or do we only do distributed? There's definitely scope for both of those. I would say with those smaller systems, you don't have the same economies of scale. So it can be a little bit more challenging to actually get that business case to stack up. But we've seen quite significant cost reductions in batteries over the next 12 months. And that's probably a trend that will continue as well. So I think as those costs come down, the economics of smaller distributed batteries should start to improve.
Lovely. Next one is, when do you think large-scale batteries will take over the FCAS market entirely, and small batteries won't be able to compete?
So there's no reason that small batteries can't compete. There's actually, so batteries, both big and small, have already almost taken over the FCAS market. So they've really pushed out, coal, gas, and hydro. That change has been quite significant over the last 5 or so years. But sometimes people are surprised to see just how much of market share those smaller systems actually have. I think they definitely can be more competitive, because often with a smaller system, it has been built for some other purpose. So it might have been built to provide backup or arbitrage, kind of retail tariffs and the like. And then the FCAS is almost like the cherry on top that it does. So they don't actually bid very high prices. So we are seeing them being already quite competitive in those FCAS markets.
Perfect. We might make this the second last question, and this is a question from Peter, and I appreciate Peter asking the question, but he puts a caveat before he asks this question by saying, please excuse the naive question, he's still learning, but he's asking, nuclear might be a red herring, but what about pumped hydro? Is this a sensible or likely storage addition to the NEM, and would it challenge or complement the best case?
Yeah, so I mean, good question, and definitely no such thing as a silly question. I think we're all learning in this industry, and that's what these training courses are about. So never shy away from a question. So with pumped hydro, that's actually our most mature storage technology that exists. It's been around for about 100 years. We know pumped hydro very well. Where the challenges come in with pumped hydro is that these are projects that are very complex. They're quite dependent on the geography, of the particular project. And there can be a lot of uncertainties. Once you start tunneling, you find all sorts of things that you didn't realize in your business case. And then it's quite easy for timelines and costs to, start increasing much more than you thought initially in your feasibility studies. So pumped hydro, I think certainly has a role, especially in that longer duration storage. But what we've got to be careful about is thinking that pumped hydro is our silver bullet, and there's really no silver bullet in the energy transition. I think it's something that we can have in our arsenal, but we can't expect that pumped hydro will be the thing that saves everything. Therefore, we don't need to say invest in batteries. It's not a case of do we do battery or do we do pumped hydro. I think there's a role for both. Battery has an advantage in that you can pretty much put them anywhere, and they are much quicker to roll out. You've got much more certainty over your costs and timelines. But, if we are going to replace all the coal in the grid, I think there's a fundamental need to have long duration storage. So there is definitely a role for technologies like pumped hydro to be part of that mix. We've just got to be clever about the projects that we're picking. Snowy 2.0 is a good example. It's probably, there's so many suboptimal things about that particular project. So that's really not the pumped hydro project that the government should have invested in. But then sometimes people think because that isn't a good project, that all of pumped hydro isn't a good project. There are good projects, but we've just got to be a bit more careful about how we pick them and which ones we invest in.
I know I said that was the second last question.
But I'm happy to keep them coming.
Actually, yeah, we'll keep going then. So there's two more at least that I can see right now. So this one is, do you have the tools to effectively model the vehicle to grid systems? What would be the impact on wholesale NEM prices?
Yeah, so you certainly could model vehicle to grid, and that is something that gets done in all sorts of studies. And the key question, I guess, is how optimistic are you about the uptake of vehicle to grid? So it really all depends about scale. If it's relatively small uptake, then the impact on pricing won't be too big. But if 80% of people who have electric vehicles in 10 years' time, if 80% of them are doing vehicle to grid, then that gives you a substantial source of storage. And any time that you're adding more supply into a market, you're going to put downward pressure on prices. So it's really anything can be modeled. It's not a modeling challenge. I think the bigger challenge with modeling the impact of something like vehicle to grid is getting that trajectory right and understanding, okay, well, how many electric vehicle owners will actually partake in that behavior.
Got it. Unless there's any other questions whilst we answer this last one. This question, the person is asking, Maria, does the best course cover inertia and system strength for future opportunities, given it's still early on in terms of maturity?
Yes, so we do cover advanced services provided by batteries. So that does include system strength and inertia, and we provide you with what's known about what those services look like at this point in time. So obviously this is a super fast evolving space, and we can't necessarily predict where that will be in 10 years' time, but we can give you all the information as it stands now.
Fantastic. Well, I think that wraps up the questions. If anyone does have any other questions after this webinar, please don't hesitate to email us at training@informa.com.au, and I'm sure, Maria, you'd be more than happy to come back and provide answers to any of those questions. I wanted to take this opportunity again to thank you for your time, and I'll give you the last minute to wrap up, and we'll finish there.
Yeah, sure. I just wanted to make my contact details available to anyone as well. So I've got my email there if you want to chat about anything that was discussed in this webinar or the training services. I actually deliver both of those training courses myself. So any questions around the content, feel free to contact me. You can also find me on LinkedIn as well. So either LinkedIn or email. I'm happy to answer your questions.
Fantastic. All right. Well, thank you so much again for your time, Maria. Thank you all for participating and being involved in this webinar. There will be a recording made available hopefully very soon. And we all hope to see you in these training courses coming up in March. Thank you very much.